Good morning, and thank you for joining me, your host, Nathan Claiborne of the Phoenix Real Estate Roundup. Today is Tuesday, November 15th. The active listings on the Arizona Regional Multiple Listing Service, 20,360. And the average 30-year fixed rate mortgage, get this, you guys, 6.65%. I'll get to that in a minute. Those numbers holding steady, although the 6.65% is a really great jumping off point to what's happening right now. And that's what this podcast is about. We're going to talk about some big market forces, and we're going to talk about some stuff that's happening in the iBuyer realm of the real estate market, the iBuyer corner, rapidly shrinking corner. No, I don't mean to laugh. I shouldn't laugh. That's not funny. But first of all, I'll get to that interest rate, 6.65%. That's down a whopping 75 basis points from what it was last week. And here's why. Last week, the Consumer Price Index, you may have heard it out there in the ether being discussed, the CPI, came in at 7.7% year over year. That is to say that prices are 7.7% higher than they were a year ago. Consumer Price Index. That's a basket of consumer goods that they measure so that they can come up with a price index to measure inflation. And that's what's going on. Now, the month before is at 8.2%. And most economists were expecting it to be somewhere near that again. So the fact that it came in 0.5% less than what they expected was huge news. Really great news for a lot of reasons. The stock market certainly loved it. All of us would love it if the Fed could just quit raising interest rates. Like maybe its job is done. It's poured enough cold water on this hot economy to get this over with. So there's a lot of buoyancy in this market. And that translated into a huge day in the bond market. On Thursday and Friday, I think it was Thursday, was the biggest rally in the bond market in 30 years. And the average 30-year fixed rate mortgage had the single biggest one-day drop since they started measuring that kind of thing in 2009. Now, it's weird that they didn't start measuring it before that, but there wasn't this immediacy of data available for them to be able to measure that on a day-to-day basis. But now there is. And that's why we have interest rates at 6.65%. That's really good news. And I'll bring it back to the inventory number, 20,360. Here's what it was last Tuesday. Last Tuesday was 20,505. The Tuesday before that was 20,515. The Tuesday before that, 20,703. So my point, and I think maybe you're hearing it, is that inventory is not, the market is not being flooded with homes. We are holding steady. And in fact, overall inventory is decreasing at this point. And if the interest rates stay below 7%, we're going to see a little bit more demand seep into the market. And hopefully bring us into some kind of softer type landing so we're not panicking. Like for the last few months, everyone's been on bated breath watching this housing market play itself out. And we have lost a little bit of value since the beginning of the year, haven't we? So if you bought your house in April, you're not that stoked right now. And I talked about this last week in my podcast. On this podcast, if you bought your house in April, just don't sell it right now. We bounced off the top. That's going to happen. Now, the question is how much of a bounce and when will it flatten out? And it looks like it's flattening out right now, at least from my perspective. From the perspective looking at the fundamentals of this marketplace, there's 20,360 active listings, which is less than there have been in the last month. So that means inventory is not increasing. That means prices will probably not keep plummeting or going down precipitously or going down at all, really. It looks like demand's catching up. And I think that's true. And there's a lot of reasons for that, and it's not just interest rate related. Some of it is the fact that companies are still opening here and moving here, and lots of people are still moving here because it's still a desirable place to live over and above other marketplaces. So our demand in this market is healthy, and I expect it to remain so. It remains to be seen how the interest rate environment is going to play out. But I like what I'm seeing right now. 6.65% is a lot better than the 7.3% we were looking at last week. Now, with this deterioration of the market, the interest rate environment and the housing market environment is coming with some layoffs and some difficult news for a section of the real estate industry that we affectionately call the iBuyers. You've probably heard all that. If you've stumbled upon this podcast, you've probably heard of what an iBuyer is, but I'll just go over it. Essentially, these companies are tech-enabled house flippers. The most famous, well, there's four of them. I call the big four. Redfin, Opendoor, OfferPad, and Zillow were the companies that were most involved in the iBuying phenomena. And Opendoor and OfferPad indeed were companies were founded and formed specifically to do that. Zillow was a different story. Zillow is a different animal altogether, but they did have an iBuying platform. And then Redfin, which is closer to a traditional brokerage. You can actually just go get a job as a real estate agent there. They have a couple different packages for agents, to work there. One of which is to be paid salary. So they have a little bit different of a model, but they are definitely more closer to a brokerage. But they also did some iBuying. So these were the big four iBuyers. OfferPad actually was founded right here in Gilbert, Arizona, and they have a huge office in South Chandler, right down the street from the we serve the West and Southeast realtors of the Valley. Our office is down there too, right near OfferPad. But the reason I bring them up is because as house flippers often go in markets in bygone eras, the we buy ugly houses folks, that's what these are. They're fancy, tech-enabled we buy ugly houses. And they bought ugly houses, not that ugly, and then they fixed them up in a really perfunctory way, in a way that when you walked into it, you knew, like, oh, this must be an OfferPad house because it's the same carpet and the same bad paint job. And they didn't fix anything, and maybe they put a new AC unit. And that was their version of flipping because they were making a killing as home prices were rising rapidly in the last 2.5 years up until this past spring. Well, news came out in the last couple of weeks as, like I said, the interest rate environment has deteriorated. Most famously, Zillow, they quit their iBuying program a year ago after losing a whopping $1.4 billion doing it. OfferPad, like I said, they were founded here. They're currently laying off 7% of their workforce, slowing down their iBuying program. Opendoor laying off 550 people. Redfin is laying off 13% or 862 employees, all because they are getting their you-know-what's kicked because they bought all these houses that are now no longer going to make a profit. And if you have spent any time analyzing this business, looking at this business, you could have seen this coming from several miles away with a big headlight and maybe even a horn being blown at you. This was not hard to predict. They did not cover their backsides, hardly any of them. And there were, unfortunately, the people who were being laid off were going to reap those benefits. But they are hurting. All four of them lost a ton of money on their iBuying program. So that is a little bit of a casualty. Now, it just goes to show you that traditional brokerage, the way that real estate agents do business, is still the most effective, liquid, arm's length, fair way to buy and sell a home. It's transparent. Everything is recorded above board and available. It's nothing, these iBuyers, they're private companies and they are hedge fund, startups. And it's not, an open market is almost always a better option than an opaque market. I'll take that anytime. I want to thank you for joining me this week on the Phoenix Real Estate Roundup. This is your host, Nathan Claiborne. I'll be with you next Tuesday to talk a little bit more about the Phoenix real estate market. Thanks again.